If an asset looks cheap, safe, and universally loved by the market, it is almost certainly a lethal trap designed to steal your wealth over time. We have all been conditioned to hunt for bargains, to scan the financial horizons for beaten-down stocks, and to celebrate when we pick up a share for pennies on the dollar. But what if the greatest investors in history do the exact opposite? What if the secret to legendary compounding isn't finding undervalued garbage, but learning how to happily pay an exorbitant fee for absolute perfection? Think about that for a moment. When Warren Buffett looks at the stock market, he isn't searching for clearance sales. He is looking for masterpieces, and masterpieces never look cheap. They never have. They never will. Yet ordinary investors walk right past them every single day, blinded by the high price tag, whispering about market bubbles and impending corrections, while missing out on the most powerful wealth generation engines on Earth. Why does the human mind instantly recoil from a high price-to-earnings ratio? It is not an accident. It is a deeply ingrained survival mechanism. For thousands of years, our ancestors learned that paying more than something was worth meant starvation, waste, and vulnerability. If you traded too many resources for a broken tool, your survival was threatened. We carry that exact biological programming straight into modern stock exchanges. When we see a company trading at an elevated multiple, our nervous system fires off warning signals. We feel a physical sense of unease. We tell ourselves it is too late, that the easy money has already been made, and that buying now is pure recklessness. Warren Buffett spent decades analyzing how this emotional glitch destroys potential fortunes. He realized that the market is a psychological mirror reflecting our collective fear of paying up. Most people believe that a high price means high risk. Buffett discovered that a high price often reflects an unassailable economic fortress. Think about how we treat everyday life. If you want to buy a home in the safest neighborhood, with the best schools, zero crime, and endless demand, does it come at a discount? Never. You pay a punishing premium. If you want to buy a reliable luxury vehicle that runs for decades without a breakdown, do you look in the bargain bin? Of course not. You pay up because you know that quality eliminates future pain. Yet, when it comes to investing, people throw that common sense out the window. They buy distressed companies because the share price is low, convincing themselves they are being smart, while completely ignoring why the business is struggling in the first place. Let us pause and look at what happens when you fall in love with cheap prices. Imagine a retail store selling cheap umbrellas that break the moment a heavy storm hits. You buy a dozen because they cost next to nothing. When the rain arrives, every single one turns inside out, leaving you drenched and miserable. That is the exact equivalent of buying a cheap, low-margin cyclical company during a downturn. The low price was a warning sign, not an opportunity. Now, contrast that with a company possessing true pricing power, a business whose products are so embedded in global daily life that when inflation strikes, they simply adjust their prices over the weekend. Their customers do not leave. Their revenue does not blink. Their cash flow swells with the heavy, unstoppable momentum of an ocean tide. Naturally, Wall Street notices. The price climbs. The multiple stretches sky high. To the casual observer, the stock looks bloated and untouchable. This is where the great paradox of value reveals itself. The crowd panics and walks away, convinced the stock is too expensive. Buffett sits down, reviews the structural monopoly, and calmly pays the steep price. Why? Because he knows that a wonderful company at a fair price, or even a slightly rich price, will effortlessly outrun its valuation over time, while a terrible company at a cheap price will slowly bleed you dry. This brings us to a profound realization about human impatience. We want immediate validation. When we buy a stock, we want it to go up next week to prove our intelligence. When you buy a magnificent compounding machine at an all-time high, you often have to endure a period of stagnation or a sharp macro pullback. That is when the psychological gauntlet begins. The financial commentators start shouting warnings. Your friends ask if you are crazy for buying at the peak. Recency bias whispers that you made a massive mistake. This is the exact moment where most investors crack. They sell at a loss, desperate to relieve the tension in their minds. Buffett's superpower was never complex mathematical genius. It was emotional detachment. He learned to treat market volatility not as a verdict on his intelligence, but as the inevitable price of admission for exceptional long-term returns. He understood that a high price tag, paired with an unassailable economic moat, is merely a temporary optical illusion. Look closely at how businesses actually create and protect their advantages. Most companies compete on price, which is a race to the bottom. When you have no pricing power, every economic slowdown squeezes your margins until your business is fighting for survival. Companies trapped in this cycle deserve low valuations because they are fragile. They are expensive at any price because their future is a coin toss. Now look at the opposite extreme. Look at a company that provides an indispensable service where switching costs are practically insurmountable. When a customer uses a product every single day without even thinking about it, that habit creates a recurring revenue engine that functions like a private central bank. Buffett often looks for companies that could survive an idiot running them, because sooner or later, one will. Think about the weight of that statement. If a business requires a visionary genius at the CEO desk just to keep from collapsing, it is too expensive at $0. If a business is so structurally bulletproof that even an incompetent successor cannot wreck its cash flows for a decade, then paying a premium for its shares is one of the safest acts in finance. We spend so much time analyzing quarterly spreadsheets that we forget the most powerful asset a company owns is entirely invisible. It is human habit. It is trust built across decades of consistent execution. When you buy shares in a wonderful company, you are not buying a collection of balance sheet entries. You are buying a tiny fraction of human routine repeating itself millions of times a day across the planet. People keep buying the same trusted goods, relying on the same essential services, and choosing the familiar name through wars, recessions, and technological revolutions. That persistence is the engine behind the valuation. When the market slaps a high multiple on a company, it is trying to price in the permanence of that human habit. The mistake amateurs make is assuming that permanence will end tomorrow just because the price looks high today. The real art lies in knowing the difference between a temporary fad commanding a speculative premium and a permanent structural monopoly that justifies its price tag. Think about the psychological toll of waiting on the sidelines. If you decide that a company is wonderful, but its price is too rich, you enter a game of patience that can last for years. While you sit and wait for a market crash that fits your rigid valuation model, the company is quietly compounding its earnings, buying back its own shares, and widening its moat. By the time the price finally drops to your desired level, the underlying business is twice as large, twice as rich, and twice as powerful as it was when you first walked away. You saved 20% on the entry price, but you missed out on a doubling of the enterprise. It is the classic trap of the perfectionist investor. Buffett frequently reminds us that it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. That single distinction is the ultimate key to recognizing when something is truly too expensive. A fair company, one with average margins, cyclical revenue, and modest competitive advantages, is always expensive if you pay a premium for it. The slightest macro shock will break it. A wonderful company absorbs shocks the way a sponge absorbs water, squeezing it out later as massive, undeniable shareholder returns. When you evaluate an investment through this lens, your entire perspective shifts. You stop hunting for the cheapest ticket in the room. You start hunting for the highest quality machine, accepting that enduring quality always commands a tribute. The challenge, of course, is discipline. Knowing the difference between a high price justified by relentless compounding and a high price driven by speculative mania requires a cold, clinical detachment from the surrounding hype. When everyone around you is getting rich on temporary momentum, refusing to participate feels lonely. When a stock you love is sitting at all-time highs, adding to your position feels completely unnatural. Yet that is precisely where long-term wealth is forged. It is forged in the quiet moments of conviction when you look past the daily ticker tape, ignore the short-term noise, and trust the mathematics of enduring human utility. As you reflect on how price and value dance around each other in the market,